Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ONE Gas Inc. Annual Report. ONE Gas Inc. offers a range of essential services to its customers across the United States. At the core of their business is natural gas distribution, which provides fuel for heating, cooking, and powering homes, businesses, and industries. The company serves approximately 2.3 million customers in Oklahoma, Kansas, and Texas, catering to residential, commercial, and transportation needs. Their services include providing natural gas to households, offices, restaurants, and other establishments, as well as to vehicles such as buses and trucks. ONE Gas Inc.'s extensive network ensures a reliable supply of natural gas to its customers, making it an indispensable part of daily life in the regions they serve. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview on what could cause an increase in stock price for a company like Gas Inc. The stock price of a company like Gas Inc. can be influenced by various factors that contribute to its overall financial performance and market perception. One key factor is the company's ability to adapt to changing market conditions and consumer demands. If Gas Inc. has successfully implemented strategies to increase efficiency, reduce costs, or expand its product offerings, it may attract more investors and drive up demand for its stock. Another significant factor that can impact a company's stock price is its financial performance. A strong revenue growth, increased profitability, and improved cash flow can all contribute to an upward trend in the stock price. Additionally, positive news about the company's future prospects, such as new business ventures or partnerships, can also boost investor confidence and drive up demand for the stock. Furthermore, external factors such as changes in government regulations, industry trends, and economic conditions can also impact a company's stock price. If Gas Inc. is well-positioned to benefit from these changes, its stock price may increase accordingly. In summary, an increase in the stock price of Gas Inc. could be attributed to a combination of factors including the company's ability to adapt to changing market conditions, strong financial performance, positive news about future prospects, and favorable external factors. ONE Gas Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. ONE Gas Inc. trades at a higher price-to-earnings ratio of 20 times and a lower price-to-book ratio of 1.56 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 3.18%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline for natural gas distribution companies can be categorized into 3 main areas: growth drivers, decline drivers, and neutral drivers. Revenue growth is primarily driven by capital investments in safety, integrity, and reliability of the natural gas distribution system, customer growth, rate case filings and adjustments, whether normalization mechanisms, equity issuances, and regulatory mechanisms. On the other hand, revenue decline is mainly attributed to decreased energy use due to extreme weather events, changes in customer usage patterns, competition from electricity and other energy alternatives, and weather temperatures. These factors can lead to a decline in consumption or number of customers, resulting in reduced revenue for natural gas distribution companies. It's worth noting that some drivers have a neutral impact on revenue growth or decline, such as capital availability and access to funds, which do not directly affect revenue. Similarly, operational and mechanical hazards or interruptions may impact costs, but are not primary drivers of revenue growth or decline. Net income experienced fluctuations between 2023 and 2025. Initially, it increased by 13% from 2023 to 2024, indicating a positive trend. However, in 2024, net income decreased by $41,374 compared to the previous year, showing a decline. Nevertheless, this decrease was followed by an increase of 19% from 2024 to 2025, suggesting a rebound. Profit margins also underwent changes during this period. The operating income margin increased by 9% from 2023 to 2025, while the net income margin rose by 23% over the same period. This indicates that the company's profitability improved significantly between 2023 and 2025. In contrast, the gross margin showed a slight decrease in 2020 compared to 2021 and 2022, but this trend is not directly comparable to the changes in net income and profit margins. The overall increase in net income and profit margins from 2023 to 2025 suggests that the company's financial performance improved during this period. The reasons behind these changes are not explicitly stated in the provided summary, but they may be attributed to various factors such as cost-cutting measures, revenue growth, or strategic decisions made by management. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from various pages shows that the company has been able to generate significant amounts of cash from its operations. On page 27, we see that the operating cash flow for 2025 and 2024 was $206,866 and $241,317 respectively, indicating a slight increase in cash generation over the 2 years. Similarly, on page 30, the operating activities generated $578.8 million in 2025, which is a substantial amount of cash. The data from page 44 further supports this trend, showing that cash provided by operating activities was $578,833 in 2025, $368,411 in 2024, and $939,532 in 2023. This indicates that the company has been able to generate significant amounts of cash from its operations over the past 3 years. The largest amount of operating cash flow is reported on page 80, where it states that the company generated $7,797,444,000 in 2024. This is a staggering amount and clearly demonstrates the company's ability to generate positive operating cash flow. Overall, the data suggests that the company has been able to consistently generate significant amounts of cash from its operations, indicating a strong financial performance. The company's debt level has undergone significant changes over the past year. On one hand, the total debt-to-capital ratio decreased from 47.6% to 40.9%, indicating a reduction in debt burden. Additionally, long-term debt decreased from $2,385,286 in 2024 to $2,356,038 in 2025. However, on the other hand, long-term debt increased from $2.2 billion in 2024 to $2.5 billion in 2025, which may indicate an increase in overall debt. In terms of interest expenses, there has been a decrease in most cases. Interest expenses decreased significantly due to a lower interest rate on the unsecured term loan, and interest expense decreased by $4.4 million in 2025 compared to 2024. The interest rate on commercial paper also decreased from 4.77% to 3.94%. However, there was one instance where interest expenses increased, but this was actually a decrease. Overall, the company's debt level has shown mixed results, with both decreases and increases in different areas. Interest expenses have generally decreased, indicating a reduction in financial burden. Management is optimistic about the company's outlook and strategy. The company's mission is to deliver natural gas for a better tomorrow, focusing on engaged and high-performing workforce, safe operations, capital investments, serving customers, and delivering foundational energy. The company plans to adjust rates in response to changes in customer usage and recover incremental capital investment through periodic rate reviews. Management aims to maintain an authorized return on equity (ROE) of 9.4% in Oklahoma, with a deadband of 8.9-9.9%. The company is committed to pursuing a zero-incident safety culture, relying on training and development performance management, and shared responsibility. Financial performance will be contingent on various factors such as regulatory construct, natural gas consumption, customer growth, operating performance, and perceived value of natural gas. Management believes regulators will continue to allow recovery of expenditures related to pipeline integrity, pipeline and cybersecurity, and environmental compliance. The company expects to maintain its current level of operations with flexibility to finance infrastructure investments. It aims to access capital markets based on market conditions, financial condition, and credit ratings. Management intends to maintain credit metrics at a level that supports a balanced approach to capital investment and return of capital to shareholders via competitive dividend. However, the company acknowledges that various factors such as ability to recover costs and income taxes, cyber tax, changes in regulation, economic climate affecting customer demand, and pandemic or health crisis disrupting operations may impact its future outlook and strategy. The company's financial activities have been notable for several key developments. Firstly, the company has consistently paid dividends to its shareholders, as evidenced by multiple references throughout the report. This indicates a commitment to returning value to investors through regular distributions. In addition to dividend payments, there is also evidence of share buybacks, albeit indirectly. While explicit information on share buyback transactions is lacking, the report does mention a net reduction in shares outstanding. This suggests that the company has been actively reducing its share count, which can be seen as a form of share buyback. Concerns about inventory buildup and supply chain disruption are valid given the current situation. The unavailability of adequate natural gas pipeline transportation and storage capacity poses a significant risk, as does the decrease in natural gas supply. Disruptions to pipeline capacity due to operational failures or legislative/regulatory actions can also have a ripple effect on the entire supply chain. Furthermore, external factors such as acts of terrorism, cyber attacks, or acts of war can further exacerbate these issues. Cyber attacks or breaches of technology systems that could disrupt operations are another potential threat, as is the changing regulatory landscape for natural gas distribution services. Adverse weather conditions and variations in weather also pose a risk to supply chain stability. These concerns highlight the need for careful planning and contingency measures to mitigate potential disruptions. That concludes the financial summary for ONE Gas Inc. Feel free to comment below, and I will be happy to answer them when possible.